Hello everybody, this is Coach D here with TackleTraining.com. I'm about to go through our weekly options report and pick a candidate for us to look at. And the purpose of this video is to help you to remember to consider the implied volatility when you're looking to buy or sell options. And so when you're looking at an options, candidate, and you're wondering whether or not it's a good time to buy options or if it's a good time to sell options or what option strategies to implement, it's really important that you remember the volatility. Remember to consider that implied volatility. So I'm going to scroll down here on the options report this week. We got a handful of really good looking picks. And I already kind of looked at these and I discovered I really like this Dollar General setup. So we got a beautiful looking cup and handle here on Dollar General, ticker symbol DG. It's got a cup and handle type pattern that's forming, and this pattern on average we think can break out. So that leads me to think, well, maybe we can find a bullish strategy that can help us make money. And I can buy call options, I could sell put options, I could do a bull put spread. I can do any number of different options trading strategies. But if I want to take advantage of the directional breakout here, I'm going to do some sort of directional delta strategy, which usually means buying a call, maybe doing a debit spread or some other fancier trade. But I want to make sure I understand the implied volatility. So I'm going to switch gears here and go to the Thinkorswim trading platform here. And I've got the Dollar General options chain open up here. And a couple of things to consider. When you're looking at an options chain in the Thinkorswim platform, over here on the right, you get all these numbers, and what these numbers tell you is the amount of implied volatility they're pricing into the options. So for example, if I was considering these March options, they have a 28.63% implied volatility priced in. But if I were to come out here and consider looking at, say, May options, those May options are pricing in about 25%. So they're pricing in about 3% less in implied volatility ballpark for you. And the reason those March options are probably pricing in more implied volatility, I'm guessing, would be around earnings. And so we have to factor that in. And what that number tells you is it's an annualized number that, 25% for May, for example. It's an annualized number, but there's 95 days until expiration on that. And so that 25% of the stock price, which would be, closer to 30 bucks or so, they're pricing in about $12.14 some odd cents up or down. So now I'm going to go to the chart here and show you an indicator you can apply. It's called implied volatility. And you can add that to your chart. And I also usually put that on there with some historic volatility. I'll put those into one. And you can just find implied volatility and historic volatility and put them into the same little indicator window and apply those to your chart. And I already have them on there, so I'm going to go ahead and click on OK. And this shows you the average implied volatility for all the options out there on this particular stock. And we've got an earnings announcement coming, and the implied volatility right now is right here. And it's kind of in the middle. It's showing you that historically that implied volatility has been higher, it's been lower. And you'll typically see it spike around earnings announcements. So you see high implied volatility as earnings comes out, and then it drops. And then earnings is coming and the implied volatility rises, and right after it drops. And then there's earnings every quarter, and so that implied volatility eventually starts to rise. And then it drops. Earnings again, about 4 to 6 weeks before earnings, that implied volatility starts to rise. So right now, that's kind of in the middle of its range. And what that means is that the options are median price. They're not on the cheap end. They're not on the expensive end. They're kind of in the middle price. They're pricing in some volatility, which means you're going to pay not dirt cheap. You're going to not get ripped off. You're going to pay a median price. The bigger question, I think, is which way do you think the implied volatility is going to go? And with earnings coming up here, it looks like on March 14th or so. That's about a month out, a little over a month out. And I would expect the implied volatility to rise between now and earnings, which means the options would get more expensive. And if I bought them now, that might help me make some money, assuming the stock price goes up as well. And the implied volatility also rises. That could actually benefit me. Now, I could also sell options if I was looking to, bring in some premium. But in this case, I think I'd like to take advantage of the potential cup and handle directional breakout and potentially make some money on the price rising, assuming that pattern plays out as we might expect it. And then I also could benefit from that implied volatility rising. So I think buying a call option might make sense. And if we were to go buy a March or maybe a May, let's go do a May call. That would be, give us some time to take advantage of an upward move. And we could look at, okay, the stock price is trading here at 117.25. I could go buy an in-the-money option for about $7.30 at the ask, $7 at the bid. So we could split that bid-ask spread probably towards $7.15 for that contract. And that's pretty cheap compared to the stock price. So again, to buy the stock, it would cost, 100 to control 100 shares would cost you $11,725 in a cash account, half of that in a margin account. But you can control the right to this stock for way less than 10%. You're probably down around 6-7, it's about 7% to control that particular stock. And so I'm going to go ahead and set that up here and buy that option. We can get it down to 720. We can split that spread to 720. It gives you a little notification there. And I can also put in a stop loss. I'm going to put in a first trigger sequential order. I'll create an opposite order there. And I'm just going to set up a stop loss. And I'll do a stop limit order. And we'll make those good until cancel here. And I'll just set that stop order down there and say, you know what? I am willing to risk about $300. So I'll say, risk $300, and I'll put that stop loss down there at $4.20. And that means that the stock price, I'm going to set the limit at the same price, $4.20 or so. And I'll usually do a stop, and maybe I'll set that to $4.15, give it a little bit window. That means the stock price would have to go down $4.87 to about $112-ish, give or take. I'll go ahead and set that in there. And see if that order gets filled for us tomorrow when the market opens. But that's the idea is, okay, if we buy and it goes up, we'll win. We could benefit from the implied volatility. But if we're wrong and the stock goes down, it'll stop us out. It'll limit our risk to about $300. And that's a simple way to speculate on a direction. Remember that volatility and, again, control your potential risk at the same time. This has been Coach D with TackleTrading.com. If you like this video, make sure you click like and subscribe. And follow us for more great video content. And of course, come check us out at TackleTrading.com. We always have an awesome 15-day trial you can take advantage of. And come join our community. We'd love to have you.